Welcome. Dr. Scott here to talk about accruals. Not cruel, but accruals. Accruals are the adjustments we make at the end of a period. But let's start with why. I'm going to go ahead and share my screen, and we're going to take a look actually at an adjusted trial balance. And with that, we're going to go through and get an idea of what we're trying to accomplish with adjusting journal entries and accruals. So right here, we have let me just get rid of that bar across the center of the screen. And we have an adjusted trial balance. Now, you've seen trial balances before. We created this as a product of going through the accounting cycle of analyzing transactions, creating journal entries, chronological order, posting over to ledgers, a page at a time, which gives you detailed balances. And then we take the balance of that ledger and we don't post it, but we place it on a trial balance. So we have debits and credits to cash, a T account, ending in this case with 18,450. We have accounts receivable, 7,200, supplies, 1,150, prepaid insurance. All these things are assets you probably recognize. Accumulated depreciation, a contra asset, credit balance, but it still shows up on the asset side of the balance sheet. Then we go to liabilities. We have accounts payable. We've got some unearned revenue, not earned, but unearned. And that's a credit balance. We also have salaries payable, interest payable, notes payable, common stock, all other things on the balance sheet, retained earnings also in the equity section. Then we go down to the income statement, service revenue, credit balance, and then we have our debit balances of salaries expense, rent expense, utility expense. And notice our debits equals our credits. That's a good thing. But we also have a column here of adjustments, also known as AJEs, adjusting journal entries. And we make those at the end of a period, usually the end of the year, sometimes the end of a quarter, sometimes the end of a month, basically to move things between the balance sheet and income statement. Two rules of adjusting journal entries. One is it's always one balance sheet account and one income statement account. That's what we're doing. We're rearranging the balance sheet and the income statement. Secondly, never cash. Now, you notice some adjustments here. We got adjustments to supplies, the prepaid insurance, which probably will end up with insurance expense. Then supplies will probably end up with supplies expense. Accumulated depreciation will end up in depreciation expense. That's the other side. And we see those down here. Here's our depreciation expense. Here's supplies expense. We've got some interest expense and all kinds of things going on. And then we tie it over into our adjusted trial balance where we take our two columns, the unadjusted, then we take our two columns of adjustments, and then we end up with two columns of our adjusted trial balance. So cash isn't adjusted. Remember, I said never cash. Not going to happen. Accounts receivable, that can change. We may have some revenues we need to recognize that we haven't billed yet, but we did the work. And if we did the work, we need to record the revenue, the credit, and the unearned revenue, the receivable for that as the debit. So it increases assets and it'll increase equity by increasing our net income. There's revenues, no expenses. We got an increase in revenue and net income that goes with that. Then we use up some supplies. We had 1,150 of supplies to start with. We probably did a final count and said, oh, we used what's left on the shelf. Oh, and the bottom line, we got 500 left on the shelf. We must have used 650. We're going to expense 650 as a debit and credit our supplies inventory. Prepaid insurance, we used up part of that $2,400. Now there's 2,000 left. So we make an adjustment where we debit the expense, and we'll see that down here where the $400 is for insurance expense. And then we go back up and we see the $400 reduces our asset of prepaid insurance. If it's fire insurance, the building burns down, we should get that $2,400 back in cash because we don't need to insure the building for the rest of the period of time at the value before the fire. And hopefully we're collecting the insurance proceeds as well to pay for the building because that's why we have insurance. The equipment's going to stay constant, but we're going to adjust it through this accumulated depreciation account. So we're going to credit the accumulated depreciation and debit the expense. So we do debit expenses, how to have it. So that's the big picture of what we're trying to do. We may have to record some wages, some utilities. No adjustments in utilities, but we do have the insurance expense, depreciation expense, and supplies expense adjustment, and the interest expense. All those expenses have a corresponding balance sheet account that's taken care of. and word through. So that's what's going through: one balance sheet account, one income statement account. And there's a description of what the adjustments are. And we're going to go review them directly. This time you can see, actually, this is a ChatGPT window that's showing you some of the examples, some of the conversation. And yes, you can use this as a great study tool to review this stuff. But I'm going to now go over to Gemini. And they also have a study and learn mode. That's pretty cool. So let's go in, type in Gemini.google.com. And by the way, last I checked, as a student, you can still get a free year of the pro version of Gemini. If you have a chance, you may want to check that out and scope that out, get an idea of what's that all about. Okay, so we're here in Gemini, and we're looking, and it's saying create image, write anything, looks by day, create a video, some tools. Let's see what some tools that they have around here. Okay, create images, content, images. Okay, yeah, I'm going to go there. Upload, add from Drive, photos, import code, Notebook LM. All right, this is a good place to access Notebook LM or the Help Me Learn mode here. Notebook LM, we've talked about. I actually did a video on that. Uber cool. It allows you to create podcasts, create quiz question and flashcards, to do mind maps. Well, what's nice about it is a captive audience. It only takes the input you give it. If you give it a PDF, you give it a YouTube video, you give it URLs, you will give even Word docs. It doesn't take PowerPoints at this point, by the way, but you can export those to a PDF and import those, and you're good to go. It'll take images, pictures that you have, and it will only answer questions related to the stuff you submit. There's also a deep research mode that you actually can go out and let it do some research first, and then use that data that goes with it. But I'm going to use the Help Me Learn mode because I want to go in and I'm going to, what do you want to learn? I am an accounting student in college and early in my program, learning accounting. And you help me with accruals and AJEs, also known as adjusting journal entries. Let's see what it says. Now, if we're looking here, it's saying adjusting journal entries, a secret sauce. Accrual for accrual. And again, this is accrual accounting. Cash-based accounting doesn't have receivables, doesn't have payables, but accrual accounting does, and it has that proper matching stuff, which is why we're getting things in order. So to record things when they happen, not necessarily when the cash moves, we often need to catch up the books at the end of the month, make sure our financial statements are in order. I'm going to go ahead and see if I can collapse that menu so we get more of a full screen here, a little bigger screen there. All right, think of it of this, the matching principle, which you've learned, requires us to match expenses with revenues. They help generate in the same period. That's why when we buy inventory, we don't put it on the income statement. There's no expense when you buy inventory. It goes as an asset. It's recorded and can be converted into cash, can be sold. It's only moved to the income statement when we sell it. Now, that's not an adjusting journal entry. We're actually selling inventory. Cash is not an adjusting journal entry, as I mentioned before. It's a transaction. If you have a bank fee, the bank fee is something that, you know what, we're going to deduct that from our cash, from our bank account. But the reality is we do not have an adjustment for cash. It's actually a transaction. So AJEs are never cash. The full specific law of action that happened, but the cash and the paperwork haven't caught up yet. Two main types: accruals, accrued revenues, performance services, but you haven't billed them yet. So we did the work. We need to recognize it. You earned it, and we need to record it. So 500 consulting services the last day of the month. Increase the asset, accounts receivable, increase revenue. How do we increase an asset? Debit or credit? See, assets are on the right-hand side. So we debit our assets and we credit the revenue, and they both go up. But we haven't billed it yet. We did the work. We need to recognize it. Accrued expenses, accrued costs like electricity or wages. You haven't paid it yet. Maybe we pay our wages January 5th for the December work that our employees did. And since you use the resource, you need to record the expense. Employees work the last 3 days of the month, but payday is until Friday. Increase the expense. Again, we debit the expense and credit the liability. The salary is payable. So we have a payable account on the balance sheet, and we have our expense account on the income statement. Accrued expenses, walking through how to calculate. We'll walk through that. I'll ask guiding questions along the way. Which path should we take? Okay, let's start with wages. And let's see what it proposes. Accrued wages, okay, or salaries are a classic example because of how common they are in the real world. Most company pay employees on a schedule like every 2 weeks. So December 31, the end of the fiscal year, your employees have worked for 3 days since the last payday. They've earned $3,000 in those 3 days. They won't actually receive paychecks till January 5. So we have a December 31 entry, end of the period, to record $3,000. Even though the cash hasn't left the bank account yet, these employees provided labor in December. And according to matching, we need to record $3,000 cost in the financial statements. So we need to debit that wage expense. Now, the nice thing about knowing the number, I got a $3,000 debit, a $3,000 credit. And I know my wage expense is going to be debited. Expenses are debited typically to increase them. So whatever's on the other side is going to be credited. And we said one balance sheet account, one income statement. So that's the income statement taken care of, our wage expense. On our balance sheet, we're going to credit a payable, which turns out to be wages payable. That's the wage account. And it says, do you think we should increase expense or revenue account? Well, we just talked about that. Increase wage expense, right? And let's see what it tells us. Again, we're Gemini. Spot on. We increased wage expense. The companies use the labor to generate value during December. In accounting, when we increase expense, we do that with a debit. Now we delete the other side of the entry. Even though we're paying the $3,000 in cash until January, the company still owes the money in December. So what's the accounting equation look like? We got the assets, we got the liabilities, we got the equity. Okay, yeah, that makes sense. Which specific liability account do you think we should increase? Credit to show that we owe our employees. Well, it looks like we have a liability account that we need to worry about. And that liability we actually already mentioned was a wages payable. Some sort of liability on the balance sheet. See if it helps us out. See what it goes with. Correct. Since we owe our employees for work, they've already finished, we record liability. Usually the account's called wages payable or salaries payable in accounting. Payable is the key word that tells you we owe this, but haven't paid it yet. Now I'm going to go back to that trial balance that we had before. And you'll notice that we have, this prepaid insurance is actually same as prepaid insurance expense. Unearned revenue, you say, wait, revenue, I know where that goes. It's the income statement, right? Well, not unearned revenue. Earned revenue is on the income statement. Unearned revenue is a liability. It's like if you're an airline and you sell plane tickets, and I bought the plane tickets, I have a prepaid expense for my trip to wherever, to a conference, and I bought the $1,000 plane ticket. I paid the cash. My cash went down. My prepaid expenses, plane tickets, went up. That's an asset. If the airlines goes on strike, I better get that $1,000 back. If I don't fly and I bought a refundable ticket, I should get a refund. Until I take off and land, that $1,000 is not going to go from my prepaid down to my prepaid insurance and prepaid airline ticket. It won't go to my expenses until I fly. The same thing with the other side of it, the unearned revenue. The airline's going to have unearned revenue of $1,000 sitting. They're going to debit the cash and credit the unearned revenue. If they don't fly, they owe me that $1,000. If they do fly and I take it, that $1,000 is going to go from unearned revenue to earned revenue, from the balance sheet to income statement. So that's how that all works. That's how that all flows. Let's try an example. All right. Actually, let's dump to a supplies inventory example. I start with $1,000 in supplies. At the end of the month, I count $400 on the shelf. is my entry? And let's see if it'll give us an entry, it'll help us process it. Okay, great transition. Supplies are a perfect example of a deferral, the opposite of an accrual. Deferrals and accruals are the two things. Accruals, by the way, are estimates. We estimate that wage expense. We estimate interest expense. We have a 90-day note from December 1. We got a month's worth of interest. We estimate. We never get a bill for that 90-day note. All we know is a 90-day note has to be paid back in 90 days, principal plus interest. But we won't know, we can calculate a pretty good number what interest was incurred for that December, for that 1 month. All right, so we got deferral, opposite of accrual, because you pay the stuff up front, but you only record the expense as you use it. Starting balance, $1,000. Ending inventory, $400. Before we write the entry, we need to calculate the supplies expense. How much did we use up? Well, if we start with $1,000 worth of pens, paper, staples, miscellaneous markers, and now only have $400 worth left, how much do we actually use? Well, once we have that number, we need to increase an expense and decrease an asset. That supplies asset no longer is $1,000. And that supplies expense, which started as zero, has incurred some things during the period. So we have fewer supplies. What's the dollar amount of supplies used? So we can figure that out. This time we have to get back into this. We start with 1,000, we're left with 400. Oh, we've got 600 used. See what comes up with. Correct. 1,000 start, 400 end, 600 supplies used during the month. Since the worth of supply is gone, we have to move the cost. Adjusting it. Debit supplies expense, credit supplies inventory or supplies, the asset. Let's try one more common type. Actually, I'm going to skip over that. You can review that if you like. And then you can pause the video. Let's do interest on a 90-day note issued on 12/1 at 12%. It is now 12/31. Okay. Let's see what it does do for that. Perfect. Accrued expenses, because interest builds up, accrues every single day that you owe money, even if you don't write a check until the end of the 90 days. Principal times rate times time. Now, we have to be careful of the rate here. I said 12%, didn't I? Now, my question to you, is that 12% an annual rate or a 90-day rate or a 5-year rate or who knows what? So if we had a mortgage, and I told you my mortgage was 6%, is that 6% a year for 15 or 30 years? Or is that 6% over the life of the mortgage for 15 or 30 years? I hope you got it right by saying, yeah, that's 6% a year. Be a good deal if I could stretch it out for 30 years, but not going to happen. Same thing for a car loan. If I got a 3-year car loan and I was paying 5% a year, that's a 5% car loan on 5% on a 3-year loan, that's 5% a year. So if I say 12% on a 90-day note, that is an annual interest rate. Don't let you be confused. Because 12% 90-day, that would be 12, 24, 48% annual. A little bit usury, a little bit illegal. But remember that the rates that are quoted, unless they specifically say 12% for the 90 days, it's going to be an annual interest rate. And that's 1% a month. And bottom line, we have 1% worth of interest. And let's give it, we need a principal amount, don't we? Well, it gave us one. Let's assume a $10,000 note, 12% interest. Okay. Tricky part. Rates are annual, express the time. Oh, typically accountants and finance folks use a 360-day year, not 365. So we can do that. So a 90-day note is a quarter of that. 180-day note is half the 360, and 360 is the full year. Just in the books for December, note issued December 1, how many days of interest have built up during the month of December? Technically 31 days. Okay. And it's going to say exactly, you have 31 days. I'm going to go make my calculation easier though. Now we can plug our numbers in the formula. Remember, we use a 360-day year. So here's what they did, 31 out of 360 times 12% times 10,000. And they come up with $103.33 for the month. Again, one balance sheet account, one income statement account. So we have interest expense. Okay, that's the debit. That's the easy one. So whatever it is on the other side, we know it's not an income statement account because the expense is taken care of. It's a balance sheet account, likely a liability. Oh, is that another payable, like our wages payable? You bet. Interest payable is the 103.33. and credit, and which goes up, and a debit for 103.33, our interest expense, which goes up. So they both go up. All right. One last example. Let's do depreciation. Let's try a depreciation example. Okay. 5-year asset, no salvage value, starts at $10,000, $50,000. Average car of a vehicle these days is 50 grand. Can you believe that? I'm not buying a new car too soon. Starts at 50,000, no salvage, asset value at 50, or I'm going to say purchase price. Purchase price vehicle at 50,000. And let's go ahead, use straight line depreciation. We'll get into accelerated methods later, but right now, straight line depreciation. What is the journal entry? And in study and learn mode, it doesn't tell you. That's, one of the nice things about study and learn in ChatGPT and the learn mode here. It's not going to give you a straight answer. It's going to help process with you. Straight line depreciation method uses spend the cost of the long-term asset evenly over its useful life. It follows the matching principle. Again, we're moving it from the asset, or the contra asset is the accumulated depreciation, which will get credited to depreciation expense. Cost minus salvage value over useful life. Cost 50,000, salvage value 0, depreciation method. A couple other methods. We'll talk more when we get into depreciation of fixed assets, double declining balance, accelerated. Some of these digits is kind of cool. Accountant. Adjusting journal entry, record the depreciation. We don't reduce the vehicle directly. Instead, we use accumulated depreciation, which I've mentioned already, as a contra asset, an offsetting asset. We have contra revenue accounts that are debit balances, not credit. We have contra asset accounts that are credit balance, not debit. Allows us to keep the original cost on the vehicle, so it'll always stay there until we get rid of it. Debit depreciation expense, 10,000. Credit accumulated depreciation vehicle, 10,000. And that's how that sets. That's how it sits. So all those adjusting journal entries go into this adjustments column. Adjustments column, adjustment debit, adjustment credit. And then we tie it across. We have to finalize adjusted debit and adjusted credit balances for all those accounts, which out of that washes out the balance sheet, the income statement. We then clear out the income statement, the temporary accounts at the end of it all. We zero out revenues, expenses, service revenues, salary expense, rent expense, all get zeroed. I hope cash doesn't zero, or receivables. People still owe us money. Our equipment doesn't zero, but they all stay. Those are called permanent accounts. So that gives you the big picture of these journal entries of what we're trying to do and trying to work with accruals and making adjusting journal entries. Accruals and deferrals are the two broad categories. And we realize that accruals are estimates. We actually estimate the wage expense, the interest expense. We didn't get a bill for it. We get a pretty good estimate. We know how much overtime was worked, how much straight time, how much salary time. We got a pretty good estimate. We know how many days of interest. Again, a pretty good estimate. But accruals are still an estimate. Whereas deferrals are actual numbers. We're deferring our income, our revenues. We're deferring expenses that are already paid and taken care of. So we've got a pretty good number on those as well. They're very important. So what's going to happen? If you had a bonus based on your net income, and those darn accountants, they went out there and said, yeah, you thought you were going to make a $10,000 bonus, which is your down payment on your vehicle or your house. And you say, wait a minute, I just got a $7,000 bonus. What happened to my $3,000? I'm getting 10% of $100,000. That was that was the net income on December 30th. And then on December 31st, you're down to 70,000 net income. And you're still getting a 10% bonus on the 70, but you're saying, did those accountants rip me off? Where's that 10 grand go? Or that 30, my extra $3,000, the 30 grand down the profits. Well, these are the adjustments. These are things that we need to get in proper balance, proper matching to make it all work. Well, hopefully that kind of gives you a reinforcement and even some practice using the study mode in Gemini. Or, as I said, you can go back to ChatGPT, you can go to Notebook LM. All these tools are there at your disposal. I'm going to do one more thing before we part companies. I'm going to go back to Gemini for a minute. And I'm going to ask it if it would please give me a quiz, test my knowledge. Let me know what's going on. Can you give me a 5-question quiz? And let's see what it comes up with. I'd be happy to. Of course, it wants to test me. December 31st. Company employees have earned $4,000 in wages that will not be paid until January 4th. What's the correct adjusting journal entry? Okay, so the $4,000, we need to record the expense on the income statement and then some kind of liability on the balance sheet. So I've got wage expense of 4,000 debit. I've got wages payable of 4,000. That's a debit though. I think I'm going to credit my payable. Debit wage expense, credit cash, never cash. That goes away. Again, D is also cash. We're never going to adjust cash on this. We didn't pay anything anyways. So I'm going to debit the wage expense. And if you got A, credit the wages payable, one balance sheet account, one income statement account, you're good to go. A company started the month with 1,500 in supplies. At the end of the month, the physical count showed 500 remaining on the shelf. What's the amount should be recorded in supplies expense? You tell me. A, B, or C, or D. Started with 1,500, ended with 500. It's like A to me. So let's see if it goes with that. That's right. Expense represents the difference between what we had to start and in the end. All right, let's go down and do one more quiz question, a couple more. Recording depreciation for a piece of equipment, which account is credited to show the reduction in the asset book value? Now, we said we don't credit the cash, is obviously not the answer. Equipment, we don't credit the equipment. By the way, we do credit the intangible. If it's a patent, if it's copyrights, if it's things that are directly known as intangible assets, those would be credited. But for equipment, we have depreciation expense or accumulated depreciation. Which one's on the balance sheet? Oh, yeah, expense is going to be on the income statement. So accumulated depreciation, that contra asset account. There we go. That's right. Good to go. And then let's go ahead and take a look. A company signs a 10,000, 6% 90-day note. Now remember, that's 6% a year or 6% over the 90 days. You hope you said 6% over the year. So that's 0.5% a month. Using a 360-day year, how much interest is on December 31st? So $10,000, 10% is 1,000, 1% is $100. And we said 0.5% would be $50. And if we're looking at our answers, we get 150, 10, 650. So I did some quick math in my head. You should be able to do 10% pretty quick. And 10% of 10% is 1%. So if we said it was 0.5% a month, we got 1 month. And 1% would be, again, as we said before, $100. And 0.5% would be $50. So let's see, $50 is a good calculation. That's right. It's like 30 days, 1/12 of the year, standard calculation. Let's go jump to last. Primary purpose of making adjustment journal entries at the end of an accounting period. To align financial statements with the matching principle, to close out our permanent accounts to zero. And yeah, when would we do that? Never, I hope. To correct errors made during initial journalizing process. I don't think we made any errors there. To ensure cash balances match the bank statement. Nah, that's a bank rec. So only answer possible, matching principle. You got it. You win. Success. Okay. I skipped one. First one, I didn't actually get the answer, but we talked about it. We had the right answer, but that's okay. You can create flashcards. Let's see what it does for a study guide. And we're going to have, I put together a comprehensive study guide, matching supplies, accrued depreciation, summary, key concepts, interest, depreciation, book value, vocabulary list, key questions. There's some pretty good content here. That's pretty cool. So create something new, audio overview, web app. You can actually create an app to test yourself. Audio overview. You can pull the adjustments. It's the comprehensive study guide here. You can actually pull it into Notebook LM and have it create a podcast for you. So pretty cool stuff, pretty powerful stuff. Hope you feel that you are gaining an understanding and the flow for you using some of these tools is pretty powerful. I encourage you to use these tools before a quiz, before a test. I just ask it to ask you. Notice the learn mode here did not answer the questions directly. It processed with us. It helped us understand and it was prompting us along the way for answers. And if you get wrong answers, it says, okay, that's okay. Let's figure out what the right answer is. So hopefully you find this beneficial. Looking forward to getting together with you again soon. Thank you for your time. Be well.